A traditional business opens its doors, serves customers, and immediately yields steady, incremental cash flow. But modern tech startups operate under a completely different physiological structure. They are built for rapid, exponential growth, which requires an immense cash burn. This creates an obvious problem. Angel investors and venture capitalists are pouring billions into these companies. If they aren't taking a cut of daily profits, because there often are no profits, how exactly are they generating wealth? The answer is capital appreciation. Startup investors buy a percentage of a company, its equity, when it is worth very little. The entire strategy hinges on holding that exact same percentage until the company's valuation explodes, and then selling it. To see how the math actually works, look at this breakdown. If an investor puts $2 million into a startup that is valued at $8 million, the new total valuation becomes $10 million. The investor has effectively purchased a 20% slice of that $10 million pie. The goal now is to force the total value of the pie to multiply over the next few years. But as the startup grows, it will inevitably need more capital. When new investors buy in, the company issues new shares. Our early investors' 20% stake is mathematically diluted, shrinking down to perhaps 10%. Yet owning 10% of a billion-dollar company means their slice is now worth $100 million. They turn $2 million into $100 million. The mechanics of startup investing rely entirely on forcefully scaling the total size of the pie, rather than trying to extract immediate dividends from a small operation. A startup cannot reach that billion-dollar scale on a single initial investment. It requires a sequence of massive cash injections, raised at specific stages of maturity. Every time a startup raises money, the transaction is governed by this core equation. You take the pre-money value, what the company is worth before the check clears, and add the new investor cash. This yields the post-money valuation. The first step on this escalator is the pre-seed or seed stage. Here, angels and micro VCs inject between $2 and $10 million into unproven ideas. This is the highest risk period. The goal is simply to build a minimum viable product and prove that a paying market actually exists. Once the market is proven, the company moves to Series A, B, and C. Traditional venture capital firms take over, writing checks anywhere from $15 to over $500 million. The mandate shifts from building a product to scaling aggressively, establishing repeatable sales mechanisms and acquiring competitors. Finally, the company reaches the late stage, achieving a valuation over $1 billion to become a unicorn. Massive hedge funds and private equity firms step in to prepare the company's financials and infrastructure for the public markets. The risk of total collapse is much lower here, but so is the potential multiplier on the investment. The early investor's primary strategy is simply to survive long enough to pass the financial baton to these larger funds. Each handoff occurs at an increasingly higher valuation, triggering the multiplier effect on their initial shares. This chart shows the absolute mathematical reality governing venture capital. Traditional finance operates on a normal distribution, a predictable bell curve. Startup investing destroys the bell curve. It follows the power law. The failure rate is brutal. Out of 10 startup investments, a venture capitalist mathematically expects 5 or 6 to completely collapse, returning exactly $0. 2 or 3 of the survivors will become zombies. They manage to stay alive in the market, but they fail to grow significantly. Eventually, they might return the exact capital invested, a 1x return. That leaves the home run. One single investment out of the 10 scales exponentially, returning 50 or even 100 times the initial capital. This distribution curve explains why venture capitalists physically cannot settle for safe 20% annual returns. If they optimize for safety, the inevitable losses from the majority of the portfolio will bankrupt the fund. Every single startup an investor backs must have the potential to return the value of their entire fund. The massive financial win of that single outlier is the exact mechanism that pays for the failed bets and stagnant growth of the portfolio. A venture portfolio is entirely designed to maximize the magnitude of a single success. Mitigating the frequency of failure is mathematically irrelevant. A billion-dollar valuation is an impressive metric, but it is ultimately just paper wealth. An investor has not made a single actual dollar and cannot spend their equity until a specific transaction takes place. This threshold is called the liquidity event, or the exit. It is the moment when those private shares are finally converted into liquid cash. As you can see in this flowchart, there are 3 primary exit routes. The most common is mergers and acquisitions, where a larger corporate player buys the startup for cash or public stock. The second is an initial public offering, listing the shares on a public exchange like the Nasdaq. Finally, early investors can sometimes execute secondary market sales, selling their private shares to later-stage investors to lock in profits early. The liquidity event is the singular, high-stakes bottleneck of the entire industry. It is the only mechanism that transforms a decade of speculative, high-risk gambling into realized wealth. Investors aggressively seek out infinite upside, but they are highly pragmatic about the failure rates. To survive the math of the power law, they engineer heavy legal armor to protect their initial capital. If you read the fine print of a term sheet, you will find a clause dictating the liquidity preference. A standard 1x non-participating preference guarantees that if the company is sold, the investors recover their initial money first. The founders and employees do not receive a single cent until that debt is cleared. They also utilize anti-dilution provisions. If a startup performs poorly and is forced to raise money at a lower valuation, a down round, this clause automatically issues extra shares to the early investors. Their ownership percentage is legally protected from being severely wiped out. Startup investing is an asymmetric game of survival. It is an ecosystem designed to fund high-growth outliers, while using strict legal contracts to ensure that the heavy risks of these aggressive bets are disproportionately carried by the founders and the inevitable failures.